Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks push higher as the record-setting rally continues. We'll bring you the outlook for equities with Binky Chadha of Deutsche Bank. Plus, Micron giving an upbeat forecast amid strong AI demand. Details ahead on not just that, but the whole AI universe. And we'll break down the risks facing media and telecom companies as late-night host Jimmy Kimmel returns to TV. Taking a look at the major averages here and what we're seeing today after yesterday's slump. A little bit of a comeback today. We'll see if it's enough to push things to a record once again. The Dow just up about 42 points. So we are not seeing a huge rebound in today's session. You've got the S&P 500 actually has turned a little bit lower here, as has the NASDAQ. So a little bit of wavering already in terms of the early rally that we have seen. A couple of other things to point out as we were watching here this morning. We've got actually yields pushing slightly higher. That's something to keep an eye on. The other thing that caught my eye is what's going on in gold prices today, pushing up towards above $64 a barrel, up about 1.5%. Some increased rhetoric from President Trump yesterday before the United Nations General Assembly about Russia and the war in Ukraine. Seems like there are a little bit of jitters here in the oil market about potential threats to supply. So that's one of the things that seems to be affecting things here. And it's also feeding through to stocks. The reason I was looking at oil prices is because, well, XLE, the energy ETF, is leading gains today on a percentage basis, up 1.5%. We've had a number of investors recently come on and say they like energy stocks here. So interesting to see that action. And then XLY, consumer discretionary, leading the sort of lagging here today. We've got real estate stocks and communication services. And as always, we watch the NASDAQ 100 especially closely, right? We see what's going on with the AI trade, with large cap tech. We had Oracle today say, or reportedly going to do a $15 billion bond sale to try and raise some money for some of the recent initiatives and build outs that it's been talking about. NVIDIA, a little change today. Really the only one that stands out of the largest of large caps is Amazon, up 0.5%, although Tesla is also gaining about 2.5%. Let's broaden it out. Earlier in September, Deutsche Bank raised its year-end target for the S&P 500 to 7,000, up from 6,550. That's a level it's already surpassed. Deutsche Bank sees about half of the inflation risks posed by tariffs already passed through, while earnings have remained resilient. Joining me now, Binky Chadha, Deutsche Bank Chief Global Strategist. Binky, it's great to see you. So you raised that forecast. At the same time, you share a lot of the concerns that are out there about maybe the enthusiasm, the frothiness in the market, but stocks, you say, can still move higher even with that happening. So explain your reservations there and why you're still bullish.
Well, first of all, good morning, Julie. Of course, the concerns are basically still out there. What I would argue is that if you take a look at each of the risks one at a time, in terms of the slowing in growth, I mean, it just hasn't happened yet. I mean, a good indicator is, the macro consensus for GDP growth in the third quarter, which is almost done, is sort of, a little bit higher than 1%, whereas the Atlanta Fed is at 3.3%. Our economists just raised their forecast to 2.8%. So there's sort of a lot of catch up. There's a lot of concern, but it's really not manifesting. But what I would argue is that while the uncertainty remains, I think one of the things to keep in mind is the lesson from April the 2nd to April the 9th, which is, if the risks do materialize, we will get some movement on policies. That's been our thesis through the year and, remains our thesis. I would say in terms of thinking about the market from here to year end, one of the things that I think is sort of key to note is that, as everybody's talking about, the market's basically at new highs. But if you look at our measures of positioning, so our measure of, discretionary or fundamentals-based investors' equity positioning, it's basically been hugging neutral since early July. So I would argue that positioning is actually still a source of upside for the equity market. If you look at the drivers of that positioning, historically, discretionary investor positioning, tends to align basically with earnings growth. It's positioned for essentially 1% to 2% earnings growth right now. We just got in the second quarter 10% earnings growth. And right now, it's still early days. We still have 3 weeks to earnings season. But I would argue, we look for something very similar. And that's kind of sort of earnings growth that we've had for the last 2.5 years. It's pretty close to sort of 11%, which is the historical average. So more than anything else, things look relatively normal, I would say.
I mentioned in your intro that you think half of the tariff effect has been seen already, has flown through. What about the other half, and what is that going to look like?
Yeah, so the big picture take would be, and that's really what I would call half of the direct impact on U.S. inflation. So we look at core goods prices, and we see basically what's already happened, and we compare that with our bottom-up estimates of the direct impacts. The direct impact should be about 2.25% on the level of basically core goods prices, and we would estimate that we are 1.25. And the simple point I would make is that if the first half has not been such a big deal, how much should we fear really the second half? So I grant all of the uncertainties and the risk around that, but I'm just saying that basically, the data is saying, the first half wasn't that bad. How much should we fear the second half? Now, with the tariffs, there's second round impacts that are very difficult to handicap, which is, price of something goes up, and so something feeds into the rest. But if you look at inflation expectations, they seem relatively well anchored. Yeah, that's really the risk from the second round impacts.
So, if you're not concerned about that, if you're not seeing positioning showing signs of stress in the market, what would be the biggest risk? Even if it's not a risk that we're going to see before the end of this year, what are you most concerned about going into 2026?
At the end of the day, if the risks do materialize, the well-known risks on tariffs, so to growth and inflation, and there's too long a period of time before we get a response that alleviates those risks. So I would say it's really the reaction function of policies right now that is sort of the key.
And do you think that the makeup of the Fed going into next year then will present an added risk if the Fed is more likely to cut into a potentially inflationary environment?
I think, here the lesson to keep in mind basically is what happened in 1973 and 1974 when we had basically a negative supply shock. The Fed, as oil prices rose, actually, it was leaning towards raising rates. And the 10-year did basically nothing, maybe came down a little bit. And then we got into a recession, the Fed cut rates, so the 10-year yield actually went up. So I think that's a risk from, Fed independence, which is that if you take short rates in the wrong direction. But mostly, what I would point out for the here and now is that what equity markets have basically been responding to is the volatility in rates. And so obviously what is happening at the Fed, and the extent to which basically it impacts rates volatility has been basically a key driver of the equity market. You can check out, you can take the S&P 500 equal weight and look at it against the inverted move index, rates volatility, and you'll see it's pretty well glued together. So what did we get from the FOMC last week? We got fewer dissents than might have happened. We got rates volatility basically continue to come down, and equity markets basically, continue to rally sort of along the trend line that they've been doing basically since early July.
And Binky, just briefly, in terms of how to play all of this that we've been talking about, you are overweight financials, cyclicals, industrials. So it sounds like you think that we are at, kind of beginning of this next economic cycle.
So what I would say is, who's going to buy the market in a sector non-neutral way, which is, the discretionary investors with basically a preference. And to answer that question, and what are they going to buy, you got to ask basically, why are they basically sitting at neutral in the middle? I would argue it's cyclical concerns. So at this point, you want to basically buy, want to stick with the financials. You want to focus on the cyclical parts of the consumer and cyclical parts of the industrials. Are they going to buy mega cap growth in tech? I think they share a lot of the concerns that were expressed in the segment running up to this one. So I would, we're putting our money on basically the cyclicals.
Binky, great to see you. Thanks so much for joining us.
Thank you, Julie.
Appreciate it. Let's zoom in now on Micron. It's topping fourth quarter expectations on the top and bottom line, with revenue climbing 46% year over year. The chipmaker also issued an upbeat forecast for the current quarter as AI demand remains strong. Joining me now, Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. As we just saw, the shares are moving lower, Pat, and that's in part because the stock has been, doubled or something this year. So, but was there anything that gave you pause in what they said?
So everything they said was positive. I mean, they hit on top line, bottom line, forecast, beat expectations, but a lot of that was already factored in, right? So investors expected that they were going to be successful with HBM3E. They already telegraphed that they were going to be sold out in high bandwidth memory, which is one of the major building blocks of all these GPUs and these XPUs for AI. So there really wasn't anything new. And they also had said the previous earnings that pricing on DRAM was going up, and
that's another kind of memory.
Exactly, another kind of memory, and they reiterated that on the call today.
So no huge surprises, in other words.
That's right, and people are likely selling on the news that they did almost a little slightly better than they thought that they would do. I think investors were looking for a little bit more insights into HBM4, which is obviously the next generation that goes into these GPU chips. And then finally, which we don't talk a lot about recently, is all the memory and storage that goes into smartphones and PCs. And those two markets have pretty much been flatline to low or no growth.
And so what happens now with Micron? I mean, do we just see it continue on this sort of trajectory where it leans more heavily into the high bandwidth because of the AI story?
I think we do. It's a three-horse race with HBM between Samsung, Hynix, and Micron. And
is there enough to go around for all three, or does Micron have any edge over its competitors?
So I think one of the edges it has on its competitors is it does have a very ingenious architecture, but in the end, it's about the performance and it's about the density, which means you can crank out a lot more chips for a lower cost. So each of them have their puts and their takes. What I find interesting just overall about Micron is they were pretty much left for dead a couple of years back, and the ability for them to claw back, not talk a lot, and show up and deliver, I think is most important. SK Hynix is the big surprise story, because Samsung was the 800-pound gorilla in the entire storage and memory market, and SK Hynix through HBM took a big chunk of business away from them.
Gotcha. All right, I want to broaden it out and talk more about AI. I'm glad you're here.
Yeah.
Because the word circular has been making the rounds. See what I did there?
Yeah.
So basically, the idea that NVIDIA is investing in OpenAI, but also has a deal with OpenAI, and then Oracle is in the mix. All of these hyperscalers, chip makers, AI companies making investments sort of in each other.
Yes.
So at some point, where's the weak point in all of that?
Yeah, so the concept of vendor financing is not new. It's the scale and proportion. Billions of dollars is one thing, but we're talking about hundreds and billions of dollars of essentially vendor financing for a customer. I mean, even in retail, vendors do flooring for retailers,
sure.
Right? So But it's the
But you also get that.
proportionality.
You also, if you think about something like retail, for example, you get that money back pretty quickly. Ideally, right? You finance. You finance selling them the apparel or whatever.
That's right.
They sell the apparel that season, and then they pay you back.
Right.
When is the money coming back?
Well, that's right. And what's spooking investors and getting the conversation going too is people comparing this to .com, right? When you had Cisco, Nortel, you had all these companies financing downstream. And by the way, the internet crushed it, right? We're living in a post-internet economy. We wouldn't be here without the internet, but it did have a crash. The one thing that I was at a .com during .com crash. I saw it, and anything can be put on a spreadsheet to look good. What I think is different here, and the circularity that we have going on, is the downstream impact that we are seeing, right? You and I talked about this in the green room, but Meta is already seeing big advances through their investments, and they're not even looked at anymore as a leader in this. You have Microsoft through their enterprise SaaS products seeing a lot of lift. We did see some green shoots from Adobe in their recent earnings. ServiceNow continues to put the pedal to the metal, and let's not forget OpenAI. Again, you can put anything on a spreadsheet, is supposed to have $125 billion in revenue by 2029, and that's bigger than AWS today. A lot of things have to happen. They almost have to 10x their revenue to get there. There is risk, right? I'm not here to say there isn't risk, but those people and those companies that have done downstream AI right are seeing the benefits of it. As consumers, and let's say consumer investors, we can see, hate to use the word magic, sounds so much like Apple, even though they're not really doing much AI. But with OpenAI and how that's changing, my own small business, I personally have 10 agents that are operating and do things auto-magically for me as well.
Right.
The biggest thing that's keeping us from getting this breakout is mostly for businesses and governments.
Right.
Their data is everywhere, right? Ironically, I'm in town for a conference, a company called Cloudera that does data management, similar to Databricks and Snowflake. Huge increases. That's a precursor to an AI application breakout, is seeing those investments. And we saw with Oracle, right? The big investment in their data cloud.
Pat, we have to leave it there. I'm so sorry, but I know we'll talk again soon. So looking forward to that. Coming up, we're going to dive into the latest out of Washington. Stay tuned. President Trump threatening to sue ABC again after Jimmy Kimmel Live returned from a brief suspension. Trump writing on Truth Social, quote, "Last time I went after them, they gave me $16 million. This one sounds even more lucrative." Jimmy Kimmel took aim at Trump and FCC Chair Brendan Carr in Tuesday night's show as seeming pressure from the administration to cancel the show sparked free speech debates around the country. Joining me now on this, Terry Haines, Pangaea policy founder. Terry, it's great to see you. This has obviously been dominating a lot of the discourse. I'm curious about the implications for the companies that operate, right, in the broadcast and journalistic and media realm, what these kinds of threats mean, and are they a business threat to these companies?
Well, good morning, Julie. And yeah, they are to some extent, sure. But I think there's two things happening here. I had written for markets Sunday and Tuesday both that there's kind of cross currents going on here. On the one hand, on a pure business level, what you see from not only from Disney, the broadcaster and the speaker, but from the affiliates as well, is a desire to want to mitigate risk, and some markets will take that positively, even though it doesn't affect the bottom lines very much. The bigger threat to me is to telecom companies, because the FCC is an independent agency, very much like the Fed. It exercises congressional power, and if you get a situation where the White House Bigfoots FCC on broadcasting standards, then the next concern is that it might Bigfoot telecom companies on all kinds of things, including tech matters. And if they start doing that, you've got an agency that's dealing very arbitrarily instead of calling balls and strikes. So that's kind of a negative for me to the telecom sector. So it's essential that both Congress and the FCC itself kind of right the ship here before it's too late.
Well, Terry, it doesn't seem like the administration needs to Bigfoot the FCC. The call's coming from inside the House, so to speak. I mean, Brendan Carr said what he said. Maybe behind the scenes he was being Bigfooted, but it didn't seem like there was a lot of pressure being brought to bear. So then, what does that mean for how the telecom companies need to sort of finesse this relationship?
Well, whether or not Carr got some marching orders from the White House or not, I'm sure that one aspect of Carr's behavior was he knew that saying what he said would please the White House. So the effect, I think, is probably the same. But either way, you've got a situation here where an independent agency that's supposed to be calling balls and strikes has now shown itself to be susceptible to political pressure or to please certain masters, and frankly, the masters it's not supposed to be trying to please.
Right. Let's switch gears, but talk about a similar theme. Talk about another entity that the White House has been trying to influence. That, of course, is the Federal Reserve. Of course, despite pressure from President Trump, the Fed has sought to remain apolitical, and Fed Chair Powell even called out critics who attempt to politicize his actions in his speech Tuesday. Let's listen again to what Powell said.
The truth is, mostly people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do.
And Terry, I mean, this is entirely in keeping, of course, with Powell's line, where he has basically shut down any line of questioning that seemed to go there. He didn't really give us a lot of hints about policy yesterday, but what did you take away from the speech?
A couple of things, Julie. First, you can compare and contrast what's going on with the Fed and the FCC. As I say, they're broadly similar sorts of agencies, although they do different jobs. The FCC is showing itself kind of too compliant to the White House. The Fed is, I think, very aggressively and properly defending its independence. In fact, I'd been selling markets even before the Fed rate decision last week that one reason why they should expect 25 basis points instead of 50 was, frankly, the Fed would be anxious to show that it was not under the White House thumb and wasn't overly responding to White House pressure. What I took away from that speech yesterday is very simply that this is still Powell's Fed. What you got out of the rates decision last week was unity, except for the new governor, which was expected. I think that Trump's going to continue to be frustrated with the Fed and acting out partially as a result of the kinds of things Powell said yesterday. Trump probably also gets more frustrated with his new governor because there's a lack of influence that's already been shown, and the governors, whatever else they might be interested in, are not going to kind of follow Myron's siren song on this stuff without evidence. And finally, I know that Fed World is always very interested in looking for the cracks between governors, and that's to be expected, not least because there's money in those cracks. But what you saw from Powell last week and yesterday, I think, was a guy who's still very much in charge of the Fed and still able to marshal consensus.
And in terms of the expected rhetoric that's going to continue from the White House, do you think at this point that the market can just not ignore it, but do you think that the sort of fundamental threats to the Powell Fed are largely behind us, considering he only has a few months left?
Yeah, I think so. I think that's probably so. Yeah, and the reason why I would say that is not just kind of my own read of the body language, but also somebody like Besant, who has been counseling column here. What you've got is kind of a good cop, bad cop routine out of the White House, where and the administration, where Trump blusters about this stuff and really focuses on pushing a policy argument, which the markets frankly are swallowing to some extent. Right, Jerome Too Late Powell, the too late part gets taken up by lots of people in the markets, but where Bessent is kind of marshaling the transition and trying to put together a new Fed that is, it's not a matter of being compliant with the White House, compliant with Trump, but a different sort of Fed that's looking at itself as more of a Treasury partner, as Bessent is.
Interesting. And then, Terry, finally, I want to get your latest take on the shutdown, which you've been saying for a while is going to happen. And I thought it was interesting. You recently talked about how it is in both parties' interests right now to have the shutdown happen. They both are trying to sort of angle to get something out of it.
Yeah, the politics are, people, I think, overcomplicate this. The politics are that the Democrats need to show that they're willing to stand up to bad orange man. And Schumer got a lot of grief about this a few months ago, making a deal over an earlier shutdown threat. So they're going to have some sort of performance. At the same time, the signals Democrats are sending is we're willing to back off, provided we get some agreement on a compromise on premium Obamacare plans and premiums for Obamacare plans. And Republicans in turn have signaled that they're willing to talk about making a compromise there, just not in a temporary spending bill. So what you got is a situation, I think, where there's a signal from the Democrats. And at the same time, what Republicans want to signal is that, look, we're not the people that are making it difficult to deal with debt and deficit. These other folks are. The Democrats are. So it serves both of them to have a little performance this week and next. But traditionally, this hasn't mattered very much. It matters more now because of debt and deficit signals. But strangely enough, tariffs have proved to be the friends of the markets here because they're making up on a lot of the revenue that was earlier a concern.
Terry, great to catch up with you. Thanks so much for your time this morning.
Appreciate it, Julie. Thank you.
Much more markets action coming up. You're watching Market Catalyst. Stay tuned.
Welcome back to Yahoo Finance. I'm Bert Palmer. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at Micron, Instacart, and ServiceNow. Micron stock wavering this morning after its fourth quarter results beat Wall Street's expectations, and multiple firms raised their price target. That includes the firms like Barclays, KeyBank, as well as Piper Sandler. That's in addition to Wedbush, Needham, and Rosenblatt Securities. All of those raised their price targets, with Rosenblatt Securities raising it the most to $250. That's once again the highest on the street. Right now, the average price target is around $182, implying a 12% upside to today's price. And Instacart down ever so slightly this morning after Stifel cut its price target to $56 from $64. Right now, the stock is hovering around $42. The analyst cited three risks to the company, including Amazon's announcement of free grocery delivery to Prime members here in the U.S., as well as its partnership with supermarket Winn-Dixie and New York City closing a minimum wage loophole. All those the reason that could hit Instacart's revenue. There are still 18 buys, 14 holds, and 1 sell on the street. And ServiceNow, the last ticker here, that stock moving higher this morning after Morgan Stanley upgraded it to overweight from equal weight. The analyst said the company is well positioned to capitalize on the growing adoption of agentic computing. That's thanks to a strong leadership team, an attractive free cash flow growth profile, and the ability to execute regardless of the environment. The stock is still trading well below its 52-week high of 1,198. And that's it for today's top calls, but keep right here on Yahoo Finance. We'll be tracking all the latest market action.
Now time for some of today's trending tickers. We are watching Freeport-McMoRan, Rivian, and homebuilders. First up, Freeport. Those shares are falling as the company declares force majeure at its giant Grasberg mine in Indonesia. This comes after a September 8th accident at its facility that killed 2 workers. Production in the Grasberg Minerals District had been halted following the event as teams are working around the clock to clear mud and debris. A prolonged disruption at the copper mine, which is the second largest for the metal in the world, is likely to boost copper prices. Next up, Rivian. U.S. auto safety regulators opened an investigation into the company over issues with the seatbelts in its electric delivery vans. The National Highway Traffic Safety Administration said it is aware of 6 reports of potential failures with the seatbelt anchorage system for the driver's seat in Rivian's vans. Rivian said in an emailed statement to Bloomberg that its vehicles meet or exceed all applicable safety requirements, and it will cooperate with the investigation. The automaker produces delivery vans in large numbers for e-commerce giant Amazon. And finally, homebuilders, they're getting a boost today after U.S. new home sales unexpectedly jumped by over 20% in August. That marks the fastest pace of growth since early 2022. Sales of new single-family homes increased by 800,000 at an annualized rate, with the estimate looking for 650,000. The data suggests that U.S. homebuilders are successfully luring buyers off the sidelines with aggressive sales incentives. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Much more coming up. Stay tuned. You're watching Market Catalysts.
All right, well, the Fed last week cutting interest rates for the first time this year, and we're navigating how to play the banking sector in this new rate environment with the Yahoo Finance playbook. Joining me now is Chris Whalen. He's the chairman of Whalen Global Advisors. Chris, let's start kind of top down. We have rates. We've seen the rates come in, certainly on the longer end of the curve. We now know we're entering this rate cutting cycle. As you look at financials, your coverage universe, how has this changed? The setup, and what do you see the early implications of at least that move, for the companies that you're following?
The big issue for banks in the last 4 quarters has been a lack of loan demand. Deposits are growing 4.5%. Loans are growing about 2%. Mm-hmm. So the difference is going in the securities, obviously, and huge share repurchases this year. The Fed gave them all a thumbs up in the stress test. They're going to have record share repurchases. So the question is, if we have rates fall, do we see volumes pick up? That's really, I think, the key question. To me, the most attractive members of the group are the ones with exposure to the mortgage market. So think about Western Alliance, who owns one of the biggest conventional issuers. JP plays in that market, but many of the ideal names, I think, are not even banks. They're mostly non-banks, Penny Mac, that sort of thing.
Two things in there I want to click on. The first is that capital return story, and really kind of, I think, getting rid of we've had it at various points, but it feels like the financial crisis is really over now, at least to me, and kind of how that plays into the way that you're looking at banks, where it can be a material, that can really grow. It's not just, we hope the Fed will allow us to. That can be a real part of the story for these companies.
Oh, definitely. And because the Trump administration is changing a lot of the Basel capital requirements, you see banks buying back their preferreds. They're going to retire them entirely. So we're taking income out of the market. For investors who want to, they got to go look somewhere else. I think the banks are interesting simply because they have a lot of competition now. There's been a whole parade of new platforms going after the consumer. And the business side is fairly slack, except for non-bank financial companies, which have been growing double digits. So the rest of the portfolio is barely growing. But hedge funds, all the rest of them, the credit trade has been attracting a lot of attention from the banks.
Now, you mentioned Western Alliance and the regionals, and we've had a lot of conversations here around the potential for bank M&A, more bank M&A, even larger firms getting involved. How have you thought through the potential there, things you've mapped out, just how big these firms may end up going with the ability to finally do deals after 10, 15 years?
Well, we have been seeing deals. Nonetheless, the key thing is, does the target make sense? So, in most cases, the deals we've seen over the last year or two, they've really overpaid. To me, I'm much more of a fundamentalist. If I see somebody paying 2 or 3 times book for a bank, then I know they're not going to get their money back. It's just basic arithmetic. But I think, yes, if bank stocks retreat, and I think they will, I think we're looking at a peak right now, because April they bottomed out.
Yep.
That's when I told my guys to get in. And by August, it was time to get out again. So now the question is, do we stay in? I think not. I think the large caps are going to give ground. The story stocks, the SoFis, the lending clubs, they're still going to be, I think, viable. But I think you're going to look for the increase in credit costs perhaps in the third quarter and the fourth quarter. If we start to see that, then I think the street's going to retreat from the banks, because we've had a benign year.
Yeah.
We've had credit costs falling since last year. Remember, we were talking about a recession.
Yeah.
No recession. So other than the commercial,
it's been a year away for the last couple of years.
no, exactly. But other than the commercial side of the ledger, commercial real estate, multifamily real estate, even the credit sector too has been mixed, and the banks are hiding a lot of it. They're using forbearance. They don't want the building.
Yeah.
They're going to keep the tenant in the building.
Yeah.
So that kind of behavior, also some changes in accounting presentation for restructured loans, makes the banks look better than they really are.
So let's talk about some of those story stocks, the newer entrants into the sector. And you were kind of looking through your notes, and it's interesting just to see, a SoFi is now on a screener chart next to a JP Morgan. And
Oh my God.
Can you maybe just break down for us what the economics of one customer looks like at some of those different firms, and how different that is with those names now playing in the same universe for a lot of investors?
Well, SoFi is seen by a lot of people as a student loan shop.
Yeah.
They were helping people get out of their student loans and also manage their money. But the assets per customer and the revenue per customer at a SoFi are much lower than what you see at a JP Morgan. And that to me is key, because over time, the bank still has to compete with the other banks. Their overhead costs are astronomical. They have the highest overhead of any bank in peer group 1. So what that tells you is that they are still trying to grow into a Silicon Valley kind of a lifestyle for their management team. And I think, that's fine. It certainly caught the attention of equity managers this year. But over time, they do have to compete with everybody else. So again, lending club, as long as credit is benign, no problem. And they've done all these deals. They're selling, debt on their platform for BlackRock and all the rest of it. Great. But if credit costs go up, all of these guys are going to suffer, because what do they do mostly is unsecured consumer lending. We haven't seen what these platforms look like through the cycle since 2008.
Yeah.
It's a long time, right? But we haven't had a real recession. So Ally, Synchrony, all of these big consumer lenders, even Capital One, we don't know what they'll look like next year if credit costs go up. And I think that's why Chairman Powell is so cautious on this whole issue with inflation, because on the one hand, they're worried about the economy, but then on the other hand, he's staring at inflation numbers.
Well, I'm curious also, you mentioned, kind of some of the CRE things where, how a bank might think about that. But that made me think of this whole universe of whether it's private equity, private credit, whatever you want to call it, trillions of dollars now. Firms acting like banks, basically, but not being banks at all, how that factors in as you look at both the valuation for banks, but also, as we're kind of talking around, risks in the market if the cycle turns, when the cycle turns next.
Well, this is why regulators are so concerned about banks lending to non-bank financial institutions. They know that non-bank financial institutions don't have the staying power. If a bank has a bad credit, they could just put it in a closet and let it sit for a while. Or if they take a property, they can just hang on to it because they have deposits to fund it. Non-banks don't. And you've seen the big Apollos and Ares and all the rest of them, Brookfield. Everybody's in this trade now. But if the trade starts to see a diminution in liquidity, then we have a problem.
We talked about it for years. We'll see.
This will be a great story next year.
I was going to say, it feels like the one that I'm going to spend my whole career looking at and waiting for that.
Well, we haven't had a real crunch since the Great Crisis. 2021 was bad, but very temporary. So the question is, with credit still looks great. If you look at 2021, credit's been flat since then.
2025 has been a good year for U.S. stocks. The S&P 500 registering 28 record highs so far this year. Where has that strength been felt on the ETF side of the ledger? Aniket Ulal, CFRA Research Head of ETF Data and Analytics, joins me for this week's ETF report brought to you by Invesco QQQ. Annika, thank you so much for being here. So one would imagine that things like the SPYs and the QQQs have had good years along with stocks overall. But when you drill down into it, what really stands out to you is the outperformers that we've seen this year?
You're right, SPY has had a good year, but there are certain ETF sectors that have outperformed SPY and done really well. One is banking, particularly European banking. If you look at an ETF like EUFN, which is the iShares MSCI Europe Financials ETF, that's up almost 50% this year. We knew coming into this year that this was going to be a good year for banking, particularly in the US. We expected some tailwinds from deregulation, as well as increased M&A activity. I think the strength in European banking has caught everyone by surprise. Actually, we've seen almost twice the return in European financials relative to US banks, which have actually done quite well. You know, you've got banks like Santander, HSBC, and others that are held in this ETF. So I would say European banking has certainly been one strong sector, driven both by, on the lending side, a stabilization in net interest income, and on the non-lending side, some growth in non-interest income driven by capital markets activity and so on. So certainly that's been a strong sector.
And Annika, do you think that strong, a two-part question, if you will, do you think that the financials performance is going to continue, and do you think that those European ETFs are going to continue to outperform the US financial ETFs?
Right now, we are overweight at CFRE. We're overweight financials, so we are bullish on the financial sector, continue to be strong. European banking is another one we do think will outperform well into next year. As you pointed out, it has had a good run this year, but we think that will continue because the fundamentals continue to look strong, both in terms of net interest income stabilizing, as well as continued growth from non-interest income sources. So we are bullish on European banking looking ahead into next year.
And then another area that has outperformed this year has been social media and video gaming, which is interesting. What's been propelling those? And as always, it's important what's in the ETF to try to understand why they've done so well.
You're absolutely right. There are a couple of ETFs in this space, and it sits at a very interesting intersection of technology, communication services, and consumer discretionary, which is why I think these ETFs have done well. You've got ETFs like the Global X Social Media ETF, ticker SOCL, which has actually done well, up about 45% this year. And then ESPO, which is a VanEck ETF that focuses on video gaming. As you pointed out, the holdings do matter. SOCL is a little bit more tilted towards social media companies, think stocks like Meta, Reddit, all of which have had a strong year. Whereas ESPO is a little bit more focused on gaming, holds stocks like Roblox, Unity, AppLovin, some of which have actually benefited from global growth, particularly Roblox. So those are sectors that have actually had a very good year so far.
And then also telecom. Now, telecom is interesting because it's not one that has gotten a lot of attention. But again, this is one where there's a couple things going on, but one of the things is you have to look under the hood to see what's in the telecom ETFs.
Absolutely, because we've talked so much this year about tariffs, but actually we found that the one big beautiful bill has probably had a bigger impact on some of these ETFs, in some ways more than tariffs. And one of these implications is on the tax side. If we look at what happened in the beautiful bill this year, you know, companies were allowed to essentially deduct their entire expenses in the same year. So there's kind of a return to full depreciation on qualified capital assets. That's huge for telecom companies. These are companies investing a lot in towers, in fiber deployment. So companies like AT&T, Verizon, T-Mobile are really able to save a lot in cash tax saving. For AT&T, so maybe 6 to 8 billion over the next 3 years. That's really helped tickers like IYZ, which is the telecom ETF. So that's a sector we like right now based on the benefits from the beautiful bill.
So you talked about it playing out over the next several years, but you don't think that is priced in yet, that there's further potential upside here?
We do think there's further potential upside. We actually have a buy rating on this ETF, but of course some of it is priced in because investors can look ahead and see the benefits already.
Annika, thanks so much for joining us. Appreciate it.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, with stocks at record highs, we'll get a read on overlooked areas to invest in the market. Plus, we'll get a read on data center demand following Micron's strong forecast. And how will President Trump's H-1B plans impact the labor force and the tech industry? We'll discuss. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. Taking a look at the major averages, looks like those records are slipping away again, although obviously it's been record after record after record leading up until now. But right now, the Dow is the soul of the majors to be rising. It's up about 46 points. The S&P and the Nasdaq slightly lower here as we're sort of in a drifting in-between period. We will be getting some economic data later in the week that could give a little bit more direction. And while markets are hovering near the flat line today, that of course comes after a rally that has seen all three major indices notch records in September. And it looks like the momentum could continue with nearly a quarter of S&P 500 companies expected to beat analyst expectations in the third quarter. That's the highest measure in over a year. It's according to Bloomberg Intelligence. Joining me now in studio, Carol Schleif, BMO Private Wealth Chief Market Strategist. Carol, it's good to see you. Thanks for being here.
Great to be here. Thanks.
So it has been this interesting melt up that we have been seeing, as many people have deemed it, melt up. What kind of happens from here? What are the sort of upside catalysts that could continue to propel it? Or do we even need a catalyst and it's just sort of momentum carrying us?
Yeah, I'm not sure we necessarily need a catalyst, but we need support underneath to continue. And one of the most unique things about this melt up has been it started narrow and now it's getting broader, and that breadth is what will help sustain because you've got more companies in more industries, tangential, and even not related to AI that are starting to move. And that's really important to bring it on because typically bull market runs like this will start very broad coming out of a recession and then get narrow. And this one being the opposite, it means that there's a lot of different factors going on. And while you have certain parts of the market where there's some exuberance showing up, you don't have the broad scale and exuberance like we did in the very late 90s or even in the housing bubble as it was on the build.
At the same time, there has been concern about the opposite problem, that sort of dominance, even if it's broadening, is still those few big cap tech companies that are accounting for most of the gains just because they are so large and they have gained so much. Is there a risk inherent in that, or are you less concerned about it?
I think there's a short-term risk in terms of market booms and busts, if you will, and not extended busts, but pullbacks are pretty normal, and we haven't had one, so I think that's where everyone's sort of holding their breath, waiting for a pullback other than the brief one we had in April surrounding the tariffs. But so having some sort of a pullback is not necessarily unusual. In fact, the weekly piece I write, this one's called bear hunting. So we're looking for that sort of potential pullback, but there are ways to look through it, and the markets overall spend significantly more time in that uptrend. It's also important to remember that while those top 7 or 10 or 12 names are concentrated in the index, they're also responsible for a big proportion of the earnings and revenues, and that's flowing through to some other companies because we are seeing both the other 490 some S&P names, as well as smaller cap names, not only move, but the earnings estimates creep up for some of them as well.
So in other words, when you talk about the earnings growth, it's real, for lack of a better word. I mean, you could probably argue valuations are stretched, but we're not talking about a profitless bubble here that we are watching unfold.
Exactly. And the other thing that's unique in this one is that the spending that's happening is happening out of cash flow from companies that are generating revenues someplace else. They're taking the revenues they're generating from having shifted companies to the cloud, and they're plowing that back in to that next phase of infrastructure build. And it's coming out of cash flow. It's not being funded in wild and crazy ways like we've seen in prior things. So if you do get to a point where for a while there's extra infrastructure, if you will, prices come down and capacity gets soaked up and people find new uses for it. And every other time through history that we've had build out, even going back to the railroads, when we overbuilt railroads and had booms and busts there, we end up using the railroads and soaking up that capacity.
Right.
We did the same thing with Internet 1.0.
Exactly. Yeah, that's what I was going to say. So you guys still like tech and communications services, which is where we have seen most of this activity. Now, when you say you still favor it, does that mean adding to it, or does that mean just like you continue to ride it?
Well, I think that portfolio hygiene, as we call it, is always important. And so each individual investor is going to look at what their risk tolerance is. We have a lot of clients at this time of year that look back to where they started the year and might pull off some of that house money and put it into something else. And there's also opportunities. We've got defense stocks moving, we've got infrastructure, we've got lots of other areas in there that can participate. So just riding it, if you've got the risk tolerance in a very long-term time frame, a lot of these names are going to be the ones that participate. But then again, to your point earlier about concentration, you can own a passive index fund and you're already over-concentrated in those names.
Yeah, great point. Since you're private wealth, I do want to ask you about what you're hearing from your clients, because we are at this interesting time where people keep citing the figure that the top 10% is accounting for more than half of the spending in the US. Wealthy people seem to be feeling great right now. Is that what you're hearing from your clients? How is that manifesting?
Well, I think they feel solid. They have the capacity to spend, but the unique thing is, having covered consumer names for a very long time, that top 10% is very important. And no matter what they tell pollsters about how they're feeling, because a lot of times they're nervous, and our clients are nervous like everyone else are nervous about politics and geopolitics and all the macro things going on. But sometimes, speaking for a friend, some of that nervousness goes out and buys a new pair of shoes or buys a new bag or something like that. So there's that piece of it. But the critical component is figuring out, can they stay employed? Do they stay employed? Do they continue to grow? Because you do see some wealth effects at the fringes if markets go down and stay down. You see that nervousness out there. But then you also see, one of the common hallmarks I had back in 08, 09 when things first blew up is clients initially pulled back on spending, and then they started feeling like it was their civic duty almost to support the economy and to friends and family that they had, and put an addition on or redo the driveway or do something like that. So they're very cognizant of what goes on, but I think consumers in general, when you look at the long-term trends, they have to spend. So the employment numbers are really the important ones to look at.
Yeah, well, we're going to continue to watch those closely. Carol, thanks so much for coming in. It's great
Thanks for having me.
Appreciate it. We've got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Micron is the latest company to benefit from strong AI demand, with data centers representing 40% of the company's total revenue in the fourth quarter. This comes after NVIDIA and OpenAI inked a $100 billion deal to help fund data center build-out. Joining me now is Daniel Roberts, IREN CEO. IREN is a developer, owner, and operator of data centers powered by 100% renewable energy. Obviously, you know a lot about what's going on here in this build-out that's happening, Daniel. Talk to us a little bit about the company and what you're seeing across the landscape here as we see all of this money just being poured into data center build out.
Yeah, look, IREN, thanks for having us, Julie. IREN was founded 7 years ago by my brother and I, and our thesis was that we were the fourth industrial revolution. We were going to see the digitization of society, the emergence of all these high-performance computing applications, and that essentially the legacy data center industry located in metropolitan areas just wasn't geared up to satisfy the large amounts of power and capacity that this digitization thematic would require.
And at the time, generative AI was not yet happening 7 years ago. So you guys, like many in this business, do you still have any Bitcoin mining? I know that was something that you were in, and we've seen a lot of conversions or additions broadening into Gen AI. How's that path worked for you all?
So the same data centers that we built 5 years ago to mine Bitcoin house NVIDIA GPUs today. So we never went down a crypto pathway. We built the data centers from day one capable of supporting these applications. And the whole idea was to bootstrap the platform using Bitcoin. So we sell the Bitcoin daily, we pocket the cash, we reinvest that, and then layer in higher and better use cases over time as they emerge. We signed an MOU with Dell back in 2020. It was a bit early. But then the AI boom took off a couple of years ago. We bought some NVIDIA chips. And at the moment, we're rapidly swapping out racks of Bitcoin mining ASICs and replacing them with the NVIDIA GPUs.
Have you seen any mitigation in demand, any slowing down? I mean, are you able to even keep up with capacity, demands on what you guys are trying to do?
No, it's accelerating. And it's a demand and a supply game. And we're in this fortunate position where we've got 800 megawatts of data centers already built, which we are backfilling rapidly with the NVIDIA GPUs and replacing these Bitcoin mining ASICs. And the supply side, it is hard to bring online these data centers. We built 600 megawatts in 18 months, but the time to power narrative is real. The choke point is getting grid connected power. And the benefit of grid connected power, as we were talking about off air, is that you are connected into a network where the utility guarantees you 24/7 reliable power, and being able to build uptime guarantees and reliable GPU services requires that.
So if you talk about that renewable energy is powering the data centers, but yet it's connected through the grid, I mean, isn't there downtime that then supplemental energy is going to have to come from other sources? Because if you're looking at just wind and solar, is that what we're talking about?
And a bit of hydro, yes.
And hydro, does that provide 100% of the time the power needed?
It does. So the way it works is the utility underwrites that variability of renewable energy generation. So this is why, and partly why it's so hard to get connected into the grid, because the moment you plug in, the utility underwrites 24/7 reliable power. So the grid network in its whole is a melting pot of different generation, wind, solar, hydro, that all goes into a supply profile. The utilities role, who owns the transmission network, is to manage all that out and allocate capacity to people, generally on a first come, first service basis, based on how much reliable capacity there is.
So what happens if it's first come, first serve and you're further back in the line? How do you guarantee that you're getting that power?
You can't. You don't. And this is the whole issue. If you're starting from scratch today and you want grid connected power, you are looking 2030s.
Oh, wow. Okay. But you guys have these agreements already, and so that's why.
And this is the whole thesis 6 years ago. And a lot of it comes down to this dislocation between the real world and the digital world. So the digital world is your revenue line. It's your demand drivers. These demand curves that go vertical overnight, but your ability to service these growing exponential industries is constrained by the real world. And the real world can scale exponentially early on, but then it gets harder and harder. We've hit this inflection point where it's really hard for the real world to scale. And as we're seeing all these digital exponential applications, their growth just continues to go.
So another aspect of the renewable energy demand is that from a sort of cultural policy, political perspective, the demand for that kind of energy is waned, right? We've seen a different administration that is deprioritizing that. But clients, do they still want that kind of energy?
Absolutely. The preference is for renewable energy. And our whole thesis here was to go to the source of low-cost excess renewable energy and digitise it, convert it into these digital commodities. It's modern-day aluminium smelting, in a way, where that industry was born off going to low-cost energy, monetising that into a commodity and exporting that. The difference here is you can export it at the speed of light via fibre optic cables.
So as I was reading into the company and trying to wrap my head around it, and for investors out there who are looking at IREN, you've got some other companies that own data centers around. I think of CoreWeave as a prime example, a big visible example. The renewable energy is obviously one differentiator. How else should people understand IREN compared to some of the other companies out there presently?
The key is our asset base. So the way we're described is as a vertically integrated neocloud. The difference being that we own the entire stack. The land, the access to power, the substations, the data centers, the compute.
You're not leasing it.
We're not leasing it, and that allows us to deliver lower cost to customers, higher performance, longer term resilience because we've got that certainty. And the best thing today is we're only using less than 2% of our energy portfolio for GPUs today. So the growth ahead of us, particularly in West Texas, is really exciting.
And are you guys planning on building more out, or you're retrofitting the stuff that you have?
Both.
Okay.
We can't build fast enough.
All right, Daniel. I think that, in a nutshell, is what we're seeing overall when it comes to AI. Thanks so much for coming in. Appreciate it. We got much more markets action coming up. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Binky Chadha. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session. We've seen all three major indices reverse into the red after opening up, moving higher this morning. The Dow, as you can see there, now moving slightly lower, down 0.04%. The NASDAQ also moving lower, down 0.04%. And the S&P 500 also seeing some downward momentum, rocking in and out and above that that flat line. But largely what we're hearing is that after this run up year to date, this momentum that the market has happened, September we know is typically a weaker month, but the S&P 500 has seen quite the momentum despite that fact, up about 3% on the month. We've even heard from Goldman Sachs raising their 2025 year-end target to 6,800. That's joining the likes of Wells Fargo, Barclays, as well as Deutsche Bank, which all have raised their S&P 500 targets in recent days, recent weeks. And now we are seeing the S&P 500 roughly flat as we make our way into the later days of this month, set to conclude next week. But once again, the S&P 500 has seen quite strength. Now we're seeing a bit of a pullback here. But I do want to point to one trending ticker that has maintained the top trending ticker on Yahoo Finance's site. And it's a different one than what we've heard as of late, and that's Alibaba. We're seeing Alibaba extend that pop up now more than 10% in intraday trading. And this really is based upon the momentum that they're planning to hike their AI spend. Of course, AI really leading the momentum here. They plan to hike it above their original $50 billion target. The CEO there saying that this is the boost needed to keep pace with the global investment that we've seen around AI and the surge there. So that stock really has had quite the momentum, up more than 100% year to date. We'll certainly be keeping a close eye on that. I also do want to take a quick look at gold, because after we heard from Goldman Sachs reiterating their forecast of $4,000 by middle of next year, we are seeing some downward momentum. Gold futures down about 0.7%. UBS also had predicted for gold to reach 3,900 by the middle of next year. So just want to point out that we are seeing it in the red today after such momentum year to date. But taking a step back at the NASDAQ, the closely watched index here, bit of a mixed picture here. Nvidia roughly flat, Amazon, Meta, Microsoft moving slightly higher, Apple, Google moving slightly lower, as well as Netflix. Tesla holding on to that momentum that we saw though in recent days, up about 3%, and that's largely after we saw a return to growth after falling quite a lot this year. Once again, it is back to where we started the year, up about 8% now. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Lithium Americas, Adobe, and General Motors. First up, Lithium America. Shares soaring to the highest price since April 2024 on reports the Trump administration is pursuing a stake in the company. Joining us now for more, Yahoo Finance's Ali Canal. And this is something that we have been seeing increasingly with this administration.
Yeah, taking stakes in multiple public companies. We have the stake in Intel, MP Materials, other U.S. tech mineral firms is what the administration is eyeing next. And it's just this moment where we're seeing we need more reliance on the U.S., not as much outsourcing as we have in the past. So this would be a 10% equity stake as the company renegotiates a $2.3 billion energy department loan. Now, the company's Thacker Pass project in Nevada is one of the largest known lithium deposits in North America and is touted as a key supply chain area for up to 1 million EVs a year. So this equity stake would mark this unprecedented move that we've been talking about to shore up some of that more critical mineral supply in the U.S. Otherwise, you have Chile, China, those other countries that have those minerals, access to those minerals. So it's just another example of how the administration is trying to ensure that we have as much access to these things domestically and we don't need to go beyond.
Sure. Historically, though, that happened without any government involvement, ownership in that way. It's interesting. Treasury Secretary Scott Bessent was on Fox this morning, and Maria Bartiromo asked him about this idea. The markets would have to get their head around the government owning public portions of public companies. And he said, there are decisions that the U.S. government makes that we believe are good for society. So that is a different thing for us in the U.S. than we have become accustomed to as of late.
Yeah, and as we go through this process, how investors digest this will also be interesting. Clearly what we're seeing now, 100% pop, they're viewing this as a positive, but I still think we need to see how this ultimately plays out and what the true involvement is for these companies and their day-to-day operations.
Yeah, I mean, obviously there have been other examples. There's the Intel example. There's the revenue sharing from NVIDIA China business. So we'll see how it plays out. Yeah, definitely. All right, let's talk about Adobe as well. It's getting cut to equal weight from overweight at Morgan Stanley. What is behind that call.
Yeah, so downgrading the name, cutting its target to $450 a share. And the big concern here is slowing annual recurring revenue in its digital media business. So this essentially is a subscription growth that Adobe sees from Creative Cloud and Acrobat. And that slowdown does raise some doubts about whether generative AI will truly expand Adobe's revenue base, or is it just shifting existing spending? And shares already are down this year, I believe around 20%. At this point. So this is a company that you would think would have that access to AI, maybe see some of that momentum, just hasn't really been able to deliver. Shares down around 21% since the start of the year. Year over year, we're down over 30%.
Yeah, the concerns about competition from AI native tools, that can mean for Adobe. So obviously the analysts, they're seeing that same kind of concern. And let's talk about General Motors as well. That was upgraded to buy from neutral over at UBS, and those GM shares are up almost 2%.
Yeah, street high too, $81. That implies about 40% upside based on Tuesday's close. And UBS sees North America margins back to 8 to 10%. The street is closer to 6 to 6.5%. Plus other self-levers that GM could pull in order to offset some of those rising tariff costs. Now, there has been recent optimism over the auto sector at large, and GM in particular. We saw Barclays upgrade the stock. I just spoke with Citi analyst about the upgrade as well, and he told me that out of all the automakers, GM is best positioned to weather this storm and all the uncertainties. I asked if there were any other automakers potentially that could see a boost, and he told me to look at the dealerships. He was saying GM is best positioned out of the big three, and then in terms of other opportunities, maybe look at some dealership names. But clearly for GM, you're seeing the shares pop. Overall, the auto sector has been kind of whipsawed by a lot of this tariff back and forth. Year to date, we are up 11%.
And guess what? There's also a tie-in back to Lithium Americas, because GM owns a 38% interest in that lithium mine, and reportedly there's an energy department push for GM to maybe sign a binding agreement to take that production, to buy that production. So they're embroiled in that story also.
Right, and I wouldn't be surprised to see the Trump administration be involved with that as
exactly,
well, and maybe be the middleman between that deal.
Yes, we shall see. Thank you.
Thank you.
You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trading tickers page. Well, Robinhood is betting big on prediction markets with a new product that lets users wager on real-world events from elections to football games. Yahoo Finance's Miles Udland spoke to JB McKenzie, Vice President and General Manager of Futures and International at Robinhood.
You know, for folks who aren't familiar, what the prediction market product within Robinhood is now offering to customers, to users, and kind of what they can just do in there, and we'll go from there.
No, absolutely. So thanks for having me on. But what we did is we developed a product that allows you to look at the probability of an outcome. Now, we started this off with the presidential election contracts a little over a year ago. And then we moved into sports, we moved into economic contracts as well. But really what it comes down to being is you have the ability to trade based on probability. So what is the probability of the Fed making a 25 basis point rate cut? You can run that probability. You can also do it in sports with, you know, say you're a New York Giants fan or a Buffalo Bills fan like myself. What's the probability of the Buffalo Bills beating the Miami Dolphins? But the thing that's interesting about it is these products trade in real time during the actual event. So you can see them at the beginning, what's the probability of it occurring, and then as the actual game goes and the probabilities move up or down, you can also trade on them. So you can enter or exit, whether you're winning or maybe it's going against you. You have that ability to jump in and out of that market, which is a really, really compelling product for retail investors.
Yeah, so let's talk a little bit about, I guess, why this product is able to exist, the regulation, kind of like that space that you guys are working in such that you're able to offer this to your customers.
Yeah, so these products fall under the jurisdiction of the CFTC and the NFA. So they are considered to be federally mandated products or preempted products. What that means is just like traditional futures products that are offered throughout the United States, these prediction markets also have that ability because they fall under the jurisdiction of that regulatory body, which is a little bit different than what you have for probably the state betting products which are state by state, and some states allow them and some do not.
And so, we've gotten the football season underway. When you look at the opportunity for these prediction markets, you mentioned politics a year ago. Is it really sports in your guys' view that is the biggest opportunity, or are there other things, in financial markets or the core offering for Robinhood that you think could be bigger, or is it still too early in your guys' mind to have a strong thesis one way or the other?
No, I actually think economic event contracts are really the big opportunity that's ahead of us. And we just saw that this past week with, again, I'll use the reference, the Fed rate cut. So a lot of different people had beliefs of whether it would be a 25 basis point or a 50 or none. We had almost 40 million contracts trade just on that announcement that occurred. So the fact of the matter is people understand the importance of that Fed product or the decision on their overall portfolios. You could take that even further and look at price volatility. People may or may not want to own digital assets, but they have a strong opinion about whether or not Bitcoin's going to finish higher than, let's say, $110,000 or below. So I think that's where we're seeing a lot of interest. To be blunt, though, you do get things like the elections or sports, which are really the accelerants, because again, similar type of thing. People have strong opinions. They want to share their opinions, and prediction markets give you that opportunity.
Yeah, and I guess when you think about the user experience, and I know that Vlad has talked a lot about opening that trading window, and with some of the things you're doing with tokenization, kind of making it more 24/5, feels like 24/7 is inevitable for U.S. equities at some point, some form or fashion. Does the sports option to you, I think about it as a consumer. It's like, all right, I go from the stock market to the college games on Saturday. Does it maybe open that in a way where it just sort of formalizes that engagement, from your users around that?
Absolutely. I think when you look at the way that the markets have evolved over, let's say, my career, right? It started off with equities, options, trading until 3 o'clock or 4 o'clock, depending on what time zone you're in. Yeah. Futures moved into the 24-hour. Now you have 24-hour equities. You have crypto that's trading 24/7. News doesn't stop. You don't stop reporting the news just because it turns to be after the bill. I know, right? But I do think what you're seeing now is that people are engaged and they see things that are occurring and they want to take action. And that action has now come into the form of prediction markets. I think you're seeing it with sports. You're seeing it on economic events. You're going to continue to see it broaden. We're at the beginning of what I call this revolution with prediction markets. And we're early in that process, but we are watching it just continually change the way the markets work and how we interact with it, because guess what? That mobile device is with you 24 hours a day. You also want to know if you can access markets and trade them when you hear news that's important to you.
And is there any sense in the early going of just what the size of this market can be for you guys? Any early indications? I know there's at least one investment bank that had an estimate of how much volume they think has been done on the platform through the NFL season. Anything on that you can share with us?
Yeah, I mean, look, we started off 3 weeks ago. We did about 100 million contracts in that first weekend for
$100 million worth, or
100 million contracts traded. We're over 300 million after this past weekend. Okay. So the fact of the matter is, I think sports has opened up this opportunity for people to participate in these markets, whether it's professional or college football. Ryder Cup this weekend, I think, is being a tremendous engagement one. And then I also think people are looking at other things that impact their pocketbook that are starting to have a bigger impact. Price of gasoline, right? We're going into the fall season, so that starts to have an impact. We've talked about inflation rate, cuts, GDP. All of those start to come together. I think this is where this is starting just to build out there. And what we're seeing is our customers keep asking for more. What we're going to do is we're going to find that right product. We're going to develop it. We're going to try to be the head of the innovation for it and to give it to them.
And I'll admit that I don't have this on my phone right now. Can I bet on the temperature outside yet?
There is nothing on temperature that's out there. No, but I will tell you there are a lot of climate contracts that are out there talking about the impact of a degree here or there and what it may or may not have on the economy. So the fact of the matter is things that you're talking about, it's not raining out, but yes, there is a time where you're going to see these event contracts continue to evolve.
All right, soon enough. We'll leave it there. Thanks so much, JB McKenzie with Robinhood.
Gold just hit fresh highs and money is rushing into ETFs, but the true wild card is still asleep. If volatility wakes up, this move can shift into overdrive, and that's what we're talking about in today's Stocks in Translation. Let's begin now with a chart of gold going all the way back to 2019, and we can see that midway into 2020, gold had rallied to a fresh all-time high that topped $1,900 an ounce. But it would be another 3 years before gold would truly break out and rally again. But all of these years of sideways chop would provide fuel for the next rally higher. And we can see three distinct ceilings that emerged recently as gold stair-stepped higher. And according to the work of Todd Sohn at strategist ETF Research, ETF flows have been confirming these moves. But even though we've seen some spikes of money rushing into ETFs, it hasn't quite reached euphoria levels that has capped gold prices in the past. So in other words, there could be more room to run. So how far can gold rally? Let's zoom out with a longer-term chart of gold futures, which stretches all the way back to 2000 this time. And we can see here how gold rallied for a solid decade from 2001 to 2011. And remember that sideways action from the prior chart? That was only part of a larger sideways trend that lasted about a dozen years. And you can see that between the two dotted lines here. But at the right of the chart, focus on that now, notice the strength and slope of the current breakout from that box. The trend line is very steep, so there will be pullbacks, but the initial thrust is very strong, and we're up about 250% from those 2016 lows. That's not even half of the 650% move that we saw earlier this century. Now, let's take a look at some of the factors that's propelling gold higher right now. First up, central banks. They have been the biggest buyers of gold over the last decade. China and Russia, they started de-dollarizing in the teens, and now other central banks have been piling on. If central banks paused or actually sold gold, that would be a major headwind for prices. And we just talked about the recent ETF bid. It's not quite as important as central bank buying, but you don't want to see sustained outflows. Then we've also got dollar and government treasury yields. A weaker dollar and lower rates, those generally support gold prices. And 2025 has all been about dollar weakness, which is bullish. So right now, longer term rates are a little bit elevated, and some investors are going to dump gold and buy bonds to lock in those higher rates. But the Federal Reserve is cutting once again, which is generally bullish for gold. Also, gold can benefit as an inflation hedge and an Armageddon hedge. So geopolitical uncertainty and higher inflation, they can be bullish for the yellow metal. Now here's the kicker. We've got one more chart of gold futures over the last 5 years in white, and we've added the ticker for gold volatility in blue, which is GVZ, which you can find on the Yahoo Finance app. You can think of GVZ as the VIX of the gold market. It's based off gold options, but unlike the VIX, which tends to move opposite stock prices, gold volatility tends to rise and spike higher as gold prices rally. So GVZ is relatively quiet right now, but if it starts lifting with gold prices, that can start a bullish feedback loop. So to monitor the gold fuel gauge, watch those gold flows in GVZ. If they get truly extreme, then watch out for a pullback in price. And we probably won't get any big reports of central bank gold buying until about early 2026, but keep that on your radar. Then also watch the dollar and rates. Lower tends to be bullish, higher leans bearish. Finally, if you like to trade the day-to-day swings, watch for surprises in the monthly inflation reports. Geopolitical headlines can also move gold, but you really don't know when those are going to strike. Bottom line is, gold prices and flows are already in gear, and the wild card is volatility. And tune in to more episodes of Stocks in Translation. We've got new episodes dropping every Tuesday and Wednesday on the Yahoo Finance site. You'll find them there or wherever you find your podcasts. Stay tuned for more market catalysts up next.
The Trump administration is making big changes to the H-1B visa program, first raising the fee for new applicants to $100,000, then proposing a lottery selection process that prioritizes higher paid and higher skilled foreign workers. Joining us now to discuss how this will affect global labor markets are John Kaplan, Payoneer CEO, and Hugo Sarrazin, Udemy CEO. Thank you both for being here. And you both have sort of different prisms into how this is affecting things. John, Payoneer payments platforms for all types of sizes of businesses. And then Hugo, your business focuses on upskilling. So just so folks know the prism through which you're looking. John, I'll start with you. So for your customers who are trying to move talent around the globe, what does this mean for
It's
them?
a really fascinating moment because emerging market talent has always been the lifeblood of global innovation, right? Whether coming to the US on an H-1B visa and then starting a business here, or coming to the US, learning skills as part of our education system, and then going back to Bogota or Turkey or to China to build innovative companies. So we think short-term employment in the US, this constricts the supply, which raises the price for the workers that'll be here in the US. Long-term, I think this is probably going to drive innovation in emerging markets. And we're seeing lots of energy among our customers to keep the domestic workers, the domestic talent home, and have that invest in their businesses there. So the innovation hubs of the future may not be Silicon Valley or Seattle, they may be in Ho Chi Minh City or Mexico City.
Interesting. Hugo, is that what you're saying as well? And I should mention your background as well. You were head of the technology practice at McKinsey for a long time, so you have that experience with this as well.
Yeah, listen, it's a very interesting time. We see the labor market shifting. AI is playing an incredibly disruptive. The new generation that's coming out of school is struggling to get jobs, and they're coming to platforms like Udemy to figure out how do I, get the certification that I need. I think in the short term, to your point, I think the folks in the U.S. will use the platform to kind of get the finishing certification and learning that they need. On a global basis, though, I think over the long run, we need to be very careful. We do need the innovation that comes from attracting the best talent for the opportunities we have.
But part of the argument, of course, is that we should be relying more on homegrown talent, right? So does this then provide an opportunity to folks who, like people who are coming to your platform, to try to get that extra layer of education?
Absolutely, and that's what we're seeing. I mean, year over year, so far, just on AI, 5 times more classes. Every minute, 8 to 10 people sign up for AI classes. It's a pretty important thing. They do it on technical stuff, but what's really interesting, they're doing it on the soft skills or the adaptive skills. How to do creative thinking, how to collaborate, how to communicate. So it's a mixture, but yes, people are using this moment to kind of finish and polish their degrees, or when they're trying to do a transition to a new job, to kind of get the degrees and the skills that are being demanded in the market.
John, when we think about this $100,000 fee and also the lottery portion of it, at the same time, I think of headlines of some of the big tech firms who are shelling out these huge signing bonuses, for example, for new talent. $100,000 is chump change for some of them. But where does this H-1B visa talent typically flow to in the U.S.?
Yeah, it unquestionably goes to the big firms. And the big firms can afford, Microsoft, Amazon, others can afford to pay what they want. And the largest firms set the market rate for talent. And so those firms can afford to continue to pay. The scaling businesses, the entrepreneurial businesses, need to go global for talent. Talent is global, capability is global, brilliance is global, and entrepreneurs recognize in the digital economy, you need to find the best person for the job, and that person may not be in your same zip code, they may be halfway around the world, and if they get the skills from Udemy or elsewhere to participate, the soft skills and the hard skills, that's actually really good for global entrepreneurship.
I can't help but think of, as we talk about what you're saying about the effect on innovation here in the US, about also some of the cuts to research funding to universities, for example, which would also seem to stifle innovation to some extent.
Yeah, I mean, if you think about in China, 1.5 million or so engineers are minted every year, and it's single digit hundreds of thousands in the United States. The U.S. education system, the innovation economy, needs to invest in training people in the skills they need so that they can create the value in the companies of the next decade and the decade after that.
At the same time, I'm struck by this headlines I've seen about this being the toughest job market for new grads in a very long time. And in part because no matter what training they get, AI is doing some of these jobs, right? Whereas requiring fewer people to do the same job. So how do people adapt?
So we have a really interesting economy right now because, as you said, the newer grads are struggling to get moving. And then the kind of organizational structure that are being put in place are also different. You have a lot more, one managers for a lot of folks, and then soon we'll have agents. So you'll be managing a bunch of agents. So there's a very, very different business model that's emerging. And what we do need to do, and a side effect of this policy, is we're going to invest in making sure this new generation is getting the kind of education that they need, and to finish and learn how to do specific things that are going to be relevant in an AI world. And I don't think right now our education system was not ready for this. Right. It has happened so fast. So, I mean, we're playing a role to try to close that gap. And we need to find ways that we need to mentor the new generation. And that's one of the biggest challenges that we are not talking a lot about. How do you get mentors out there to give the opportunity to this new generation to be able to do the things that they want to do and build a family and a successful life for themselves?
John, I'm curious how all of this is affecting your hiring between, getting international talent in here and then also, are you hiring as many people because of the changes?
Sure. We've been global since day one. So we're at the first and last mile of global trade. So we have people on the ground in Lahore, Pakistan. We have teams here in New York. And that's the model that's worked really effectively for us. In terms of AI, we are looking for people who bring AI skills into the organization. And to Hugo's earlier point about soft skills, if the labor you bring has to have empathy for their customer, know how to write and communicate, understand how to ask the appropriate questions, all the skills that people used to think were liberal arts degree skills actually are super useful in an AI world of separating someone who can just write code and someone who understands how to communicate and interpret information.
I'm going to take this clip and play it for my high school junior.
Yes.
As we look for colleges, because this is he's skeptical of the liberal arts education. I'm going to tell him that you guys said this. John, Hugo, thank you so much for being here. Really appreciate it. And that's it for Market Catalyst. I'm Julie Hyman. Thanks so much for watching. We got more Yahoo Finance coming up.